The current live price for BURU Inc., trading under the ticker BURU on the NYSE American, stands at $0.20865 per share, reflecting a marginal decline of roughly $0.0016 or 0.78% in today's intraday session as of 12:23 p.m. Eastern Time. Now, the common expectation for a stock trading in this price bracket, particularly one dealing with a highly technical field like blue laser technology, is often binary, either a complete bust or a highly speculative play hoping for a massive technical breakthrough. But the deeper truth here is that the daily trading action is no longer purely about their core blue laser intellectual property. It's being driven almost entirely by the company's aggressive, nearly existential pivot into the defense and security sector, a strategic shift that is fundamentally reshaping the narrative around BURU and creating this volatile price action. This pivot is the immediate, unexpected insight that investors need to grasp, as it suggests the company's fate hinges less on industrial welding contracts and more on government procurement timelines and successful M&A integration. The market generally sees BURU as a microcap laser company wrestling with the common struggles of commercializing a niche, high-cost technology, which led to significant dilution and a recent stockholders' deficit reported at over $53 million. The stock's 52-week range, stretching from a low of $0.12 to a high of nearly $1, perfectly illustrates this tension between hope and harsh financial reality. The volatility in the intraday chart, which saw the price dip to a low of $0.189 before climbing back toward the 0.21 range and then settling back slightly, shows a battle for control at these low support levels, buoyed by the heavy trading volume, which has already cleared 12 million shares. This high volume, relative to the average, is a direct reaction to the continuous stream of announcements related to their transformation plan and the creation of a defense and security hub. This is where the expectation of a slow-burn laser technology play is shattered by the reality of a quick-moving, capital-intensive corporate restructuring. Recent news, for example, about the execution of the first tranche of a financial program supporting their Italian partner, TecneSpa, and the initial closing phase of the Orbit SRL acquisition are the primary catalysts generating this volume and keeping the stock from revisiting its 52-week lows. This isn't just about diversification, it's a necessary move to secure a new revenue pipeline and manage a deeply concerning balance sheet marked by that massive stockholders' deficit. They are effectively trying to graft a defense tech platform onto a struggling industrial laser company. This creates an immediate operational risk. Can a small, technically focused team manage this complex, international, and politically sensitive acquisition and integration strategy without buckling under the sheer scale of the administrative and financial burden? The market's reaction is a cautious maybe, which is why the stock is trading flat today despite a flurry of announcements over the last month concerning a drone joint venture with Maddox Defense and the pursuit of a $12 million public offering just 2 months ago to fund these very initiatives. A significant element of the stock's current price structure is the short selling activity. The data suggests that BURU is indeed under pressure, a common theme for low-priced stocks undergoing massive, capital-intensive pivots with weak balance sheets. The reported short interest stands at a sizable approximately 17.28 million shares, which represents about 4% of the public float. Crucially, the days to cover metric is currently quite low, sitting around 0.40 days. This low figure is primarily a function of the extremely high trading volume seen recently. While a high short interest percentage can signal a potential short squeeze, the low days to cover suggests that the existing short positions could be closed out very quickly if needed, reducing the immediate technical threat of a violent upward short squeeze reaction. However, the short borrow fee rate for BURU is currently holding around the 5% mark, which is not an exorbitant rate, but is still a non-trivial cost for short sellers to maintain their positions. Institutional firms like UBS Group and the Vanguard Group have shown activity on the institutional ownership side, with some, like UBS, reporting a massive percentage increase in their position as of the latest filing, though this data is based on the end of the last quarter and requires a pinch of salt. What we are seeing in the short-selling community is a bet against the successful execution of this massive transformation plan. The short thesis is likely straightforward. The company's financial foundation is too fragile, the acquired assets may not generate revenue fast enough, and the continuous need for capital will lead to relentless dilution, keeping the stock anchored at these sub-dollar levels. Retail investors who are tracking this need to monitor the off-exchange short volume, which was recently reported at over 56% of the total volume, a clear sign that a significant portion of selling pressure is happening outside the public exchanges. An actionable insight here is to look for a spike in the days to cover, which would indicate a drying up of liquidity that could make a short squeeze viable. Do you think a 5% short borrow fee is enough to deter short sellers from betting against this complex business transformation? Or are the risks of financial failure too high to ignore? Comment your take below. Digging a bit into the foundation of the company, BURU's core expertise lies in high-power industrial blue lasers. This technology is genuinely differentiated. Blue light is absorbed much more effectively by common industrial metals like copper and gold than traditional infrared lasers. This translates to faster, cleaner, and more efficient welding and 3D printing, potentially making it superior for certain high-precision manufacturing applications in electric vehicles, consumer electronics, and defense. The original investment thesis was anchored on this technical superiority gaining market share. However, the commercialization cycle for industrial equipment is long, capital expenditure is high, and margins can be compressed quickly by competitors or market slowdowns. Their transformation plan, which essentially sidelines or integrates this blue laser technology into a defense platform, tells us that the initial market traction or capital formation efforts were insufficient to sustain the business as a pure-play laser manufacturer. The latest updates, which focus on military applications, drone technologies, and operational resilience software via the new acquisitions, signify a desperate but perhaps necessary gamble to tap into the much larger and more stable government contract funding streams, which can provide large, predictable revenue far quicker than convincing global manufacturers to retool their assembly lines. The goal is to leverage their laser expertise within a defense framework, using it for specialized cutting or perhaps countermeasures, thereby creating a financially stable entity capable of supporting the blue laser unit. The macroeconomic pressures are certainly not helping a company in this position. The rising cost of capital and general investor skepticism toward pre-profitability, high-dilution businesses have made the capital raising process extremely difficult. BURU's recent public offering, while successful in raising $12 million, also substantially increased the share count, which is the immediate downward pressure on the stock price and the primary complaint of retail investors online. The discussion on forums like Reddit and Twitter often revolves around this dilution. Investors who bought at higher prices are rightly concerned about the constant need for more capital, which effectively sells off more of the company to stay afloat. They are calling for clear metrics on the performance of the new defense acquisitions immediately, looking for tangible revenue milestones, not just partnership announcements. This disconnect between the long-term strategic corporate announcements and the immediate, painful dilution that retail holders experience is the central conflict in the BURU trade right now. Looking ahead, the future outlook for BURU is entirely dependent on the successful execution of its transformation plan over the next 6 months. The catalysts to watch for are tangible revenue reports from the Orbit acquisition and the Maddox Defense joint venture. Specifically, the company is aiming for an Italian network contract by November 30th, 2025, and a successful Golden Power review by the Italian government for the Tecne transaction by year-end. These are